When they try to raise rates and suck out liquidity too quickly when debts are this high, chaos ensues. Can it fight 1940s-style inflation with 1970s-style policy? Going forward, the Fed can either damage the currency or damage the long tail of small and medium banks. Alden is one of the few macroeconomics and investment strategy experts who have been knee-deep into the recent bank collapse and financial crisis and have been trying to educate and warn people about what is coming. In a recent tweet, Alden says that the Fed is trying to fight 1940s-style inflation with a 1970s-style policy. In this video, we are going to analyze the information Alden is passing through her tweets and also on the recent UBS deal on the Credit Suisse Bank. In recent years, the United States economy has experienced an unprecedented amount of debt, both public and private. The Federal Reserve has been attempting to address this issue by raising interest rates and removing liquidity from the system, but some argue that this approach may not be the best course of action. Alden's statement highlights the concern that sudden policy changes can have a detrimental impact on the economy. As debt levels have reached record highs, many fear that a sudden change in monetary policy could cause a financial crisis. One of the key risks associated with rapidly raising interest rates and removing liquidity from the system is the potential for a credit crunch. Higher interest rates mean that it becomes more expensive for businesses and individuals to borrow money. This can lead to a decrease in spending, which can in turn cause a recession. Furthermore, raising interest rates too quickly can hurt the value of the dollar. As interest rates rise, the dollar becomes more attractive to investors, leading to an increase in demand. However, if the Federal Reserve raises rates too quickly, this can cause the dollar to appreciate rapidly, which can hurt U.S. exports and lead to a trade deficit. The statement also suggests that the current policy approach is outdated. This implies that the current approach of raising interest rates may not be effective in addressing the current economic challenges facing the U.S. The economy has changed significantly since the 1970s, and policymakers must adapt their approach accordingly. It also highlights the difficult choices that policymakers face. The Federal Reserve must strike a delicate balance between addressing inflation and preventing a financial crisis. Raising interest rates too quickly could damage the economy, while maintaining low interest rates for too long could lead to inflation. The Fed must also consider the impact of its policy decisions on small and medium-sized banks. These institutions often rely on interest income to stay afloat, and raising rates too quickly could lead to a decrease in their profitability. This, in turn, could lead to a contraction in lending, which could hurt the overall economy. She also adds that the Doves got caught offside last year, and now it's time for the Hawks. In another tweet, Alden also commented that when public debt levels get this high, a central bank tends to become highly politicized and lose most of its independence. Add in all sorts of other stuff, such as the list below, and the narrative becomes easier to sell. Under Powell's leadership, the Fed experienced several significant challenges in the past 2 years. Firstly, they failed to accurately predict and manage inflation. Secondly, they were embroiled in an insider trading scandal. Lastly, despite having supervisory responsibility, the Fed failed to identify systemic policy risks in banks. These issues highlight the need for accountability and improvement within the Fed's leadership. However, it is unclear whether and how the Fed has taken responsibility for these challenges and implemented changes to prevent similar issues in the future. Recent news regarding the Credit Suisse Bank collapse is that UBS has agreed to buy Credit Suisse Bank for about $2 billion. Although it faces the challenge of changing Swiss country law to be able to bypass Swiss a shareholder vote on the transaction. Switzerland's largest bank, UBS, has agreed to buy Credit Suisse for 3 billion Swiss francs, $3.24 billion. Officials from the banks have said, in a deal designed to contain a widening crisis of confidence in global finance. The agreement announced late on Sunday includes 100 billion francs, $108 billion, in liquidity assistance for UBS and Credit Suisse from the Swiss Central Bank. With the takeover of Credit Suisse by UBS, a solution has been found to secure financial stability and protect the Swiss economy in this exceptional situation, the Swiss Central Bank said. The Swiss Financial Market Supervisory Authority, FINMA, said that there was a risk that Credit Suisse could have become illiquid even if it remained solvent, and it was necessary for the authorities to take action. To enable UBS to take over Credit Suisse, the federal government is providing a loss guarantee of a maximum of 9 billion francs, $9.7 billion, for a clearly defined part of the portfolio, the government said. This will be activated if losses are actually incurred on this portfolio. In that eventuality, UBS would assume the first 5 billion francs, $5.4 billion, the federal government the next 9 billion francs, $9.7 billion, and UBS would assume any further losses, the government said. Credit Suisse, a 167-year-old bank, has been the biggest name ensnared in market turmoil unleashed by the recent collapse of United States lenders Silicon Valley Bank and Signature Bank. iTrust.capital is America's #1 crypto IRA platform. It allows users to buy and sell cryptocurrencies from their individual retirement accounts with low fees, tax-advantaged crypto accounts, and great customer support. iTrust.capital has gotten even bigger, with over $6 billion in transactions and more than 175,000 accounts created. All thanks to its wide range of exciting features, especially the new digital asset staking feature. Users can now stake Polkadot on iTrust.capital for up to 9.5% APY. This is a staking offer from a U.S.-regulated network and is completely different from offers from lending platforms like BlockFi and Celsius. Such platforms earn yield via lending rates, a venture that has proven risky and unstable. With iTrust.capital, the yield comes from staking rewards, a risk-averse way to earn a yield on your digital assets holdings. In less than 2 weeks after the beta launch, thousands of clients have staked 25% of the Polkadot on the platform, and it will only get bigger. iTrust.capital currently offers around 30 cryptocurrencies, including Bitcoin, Ether, and Cardano. The retirement account platform plans to add staking support for more cryptocurrencies in the coming months. This is a wholesome offer you do not want to miss, especially while preparing for retirement. It is a long-term investment that can help you achieve your retirement goals much faster while enjoying the vastness of the cryptocurrency industry. Please click the link in the description box to register on iTrust.capital and enjoy all its exciting features. Thanks. Forcing it to tap $54 billion in central bank funding last week. Authorities have been scrambling to rescue Credit Suisse, among the world's largest wealth managers, before financial markets reopened on Monday. FNMA, which said it had approved the takeover, said recent measures to stabilize itself were not enough to restore confidence in the bank, however, and more far-reaching options were also examined. Given the present situation of the market and the carefully awaited Fed meeting, all hands are on deck and investors are on their tiptoes as no one knows what to expect at this point. In conclusion, the U.S. economy faces significant challenges related to debt, inflation, and monetary policy. While the Federal Reserve has attempted to address these issues through the raising of interest rates and the removal of liquidity from the system, policymakers must be careful not to raise rates too quickly, as this could cause a credit crunch and hurt small and medium-sized banks. The Fed must adapt its approach to the current economic landscape and strike a delicate balance between addressing inflation and preventing a financial crisis. If you've enjoyed the video, don't hesitate to give us a like, subscribe, and turn on notifications. Thanks for watching.